Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Federal Agricultural Mortgage Corporation Annual Report. The Federal Agricultural Mortgage Corporation offers a wide range of businesses and services to support agricultural finance in the United States. The company operates through 7 distinct segments: farm and ranch, corporate ag finance, power and utilities, broadband infrastructure, renewable energy, funding, and investments. At its core, the corporation provides a secondary market for various loans made to borrowers across the country. This includes purchasing and retaining eligible loans and securities, guaranteeing payment of principal and interest on securities representing interests in or obligations secured by pools of eligible loans, and servicing eligible loans. The company also issues long-term standby purchase commitments for designated eligible loans. In addition to these core services, the corporation engages in various other activities. These include purchasing and guaranteeing securities issued by lenders and financial institutions that are secured by pools of eligible loans. It also supports loans for electric or telecommunications facilities provided by cooperative lenders to borrowers, as well as loans to rural electric generation and transmission cooperatives and distribution cooperatives. Furthermore, the corporation offers AgVantage securities secured by specific types of loans. This comprehensive range of services enables the company to play a vital role in supporting agricultural finance and infrastructure development across the United States. The stock price of Federal Agricultural Mortgage Corp. (FAMC) has experienced a significant decline of over 24% in the past year, primarily due to concerns regarding credit quality and a challenging agricultural lending environment. One key factor contributing to this drop is the increased credit provisions and charge-offs reported by FAMC. The company's net provision for credit loss expense reached $32.9 million in 2025, with notable contributions from its corporate agricultural finance and broadband infrastructure segments. The broader agricultural sector has also faced difficulties, characterized by a soft consumer demand environment and record-sized operating loans taken out by U.S. farmers. Grain producers have experienced their third consecutive year of compressing margins, increasing the risk profile for agricultural lenders like FAMC. This challenging market condition has likely exacerbated the credit quality concerns. The Q4 2025 earnings miss also played a significant role in the stock price drop. FAMC's EPS of $3.66 fell short of analysts' forecasts by 19.91%, further reinforcing negative investor sentiment. The combination of these factors has led to a decline in FAMC's stock price, with its 52-week high at $212.24 and a 52-week low of $155. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the company's financial performance can be identified through an analysis of various factors. On the growth side, net interest income, guarantee and commitment fees, volume growth in infrastructure finance, higher yielding segments, increase in infrastructure and agricultural finance portfolios, increased electricity sales, and investment in renewable energy generation are key drivers. On the decline side, scheduled maturities and repayments on existing assets, net decrease in farm and ranch AgVantage securities, weaker farmland sales prices, volatility in farmland values due to localized economic factors, uncertainty and market instability in farm and food sectors, geopolitical uncertainty, increasing energy price volatility, phase-out of tax credits supporting renewable power project investments, and increased policy and regulatory uncertainty are the primary drivers. These factors have a significant impact on the company's revenue growth or decline. The growth drivers indicate a strong performance in infrastructure finance and agricultural finance portfolios, while the decline drivers highlight challenges faced by the company due to external market and economic conditions. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. In 2023, the company generated an impressive $612,646 in net cash provided by operating activities. This figure is even more remarkable when compared to the previous year, where it stood at $80,062. The substantial increase of over $532,000 demonstrates a notable shift towards generating positive operating cash flow, which is a crucial indicator of a company's financial health and stability. The company's debt level has undergone significant fluctuations over the past year. Initially, the debt level increased from $30.8 billion in 2025 to an unspecified amount in 2024. However, a closer look at specific components reveals that notes payable rose by 13% and 13%, while debt securities of consolidated trusts held by third parties saw a 23% increase and a 26% decrease respectively. In terms of interest expenses, the company has experienced varying trends. On one hand, interest expense related to ineffectiveness in hedge accounting decreased from $11.5 million in 2024 to $6.8 million in 2025. Additionally, total interest expense saw a 2.2% decline and a significant decrease of 28%. Conversely, interest expenses increased due to changes in interest rates, with an 11.5% rise. The overall picture suggests that the company's debt level has changed significantly, while its interest expenses have fluctuated. The company's ability to manage its debt and interest expenses will be crucial for its financial health moving forward. The financial performance of various segments and regions has shown significant variations. On the positive side, farm and ranch, corporate ag finance, power and utilities, broadband infrastructure, renewable energy, funding, investments, agricultural finance loans, and infrastructure finance loans have performed well. These segments have seen increased carrying value, maximum exposure to loss, or significant growth in loan amounts. In contrast, some segments have struggled. AgVantage securities have decreased by $6.4 million, while agricultural supply chains, rural utilities, and renewable energy industries have also underperformed. The Northwest region has been particularly weak, with a low percentage of total performance. The Mid-South region has shown mixed results, with a negative cumulative loss rate indicating recoveries in some areas. However, the Northeast and Southeast regions have not been explicitly mentioned as performing well or poorly in all reports. Overall, these variations highlight the need for targeted strategies to address specific regional and segmental challenges. Management is optimistic about the company's outlook, citing several key strategies that will drive growth and profitability. One of the main goals is to continue providing an efficient and competitive secondary market for lenders, increasing accessibility of financing at competitive interest rates to rural communities and agricultural sectors. The company plans to achieve this through a combination of investing debt proceeds in eligible program assets, maintaining liquidity through regular debt issuance and investment in liquidity assets, and issuing additional capital through equity issuances. Management also expects strong growth trends in the farm and ranch loan purchase portfolio to continue into 2026, driven by opportunities for profitable future business volume growth. In addition, the company is investing in technology, business infrastructure, and human capital to enhance capacity and efficiency, expanding servicing capabilities and improving process efficiency through technology enhancements and standardization efforts. Management also notes that the company's loan collateral is well positioned to endure reasonably foreseeable volatility in farmland values. Overall, management is confident in the company's ability to navigate future challenges and achieve its goals, citing sufficient liquidity and capital resources to support operations for the next 12 months and foreseeable future. The company's hedging strategies are also effective in managing interest rate risk and other financial risks, generating positive results from fair value hedging relationships. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the Board of Directors has declared quarterly payouts from 2024 to 2026, with increasing amounts per share. This indicates a consistent effort to reward investors for their loyalty. In addition to dividend payments, the company has also engaged in share buybacks. Specifically, it repurchased approximately 751,000 shares of Class C non-voting common stock as of December 31, 2025, at a total cost of around $32.7 million. This strategic move aims to reduce the outstanding share count and potentially boost earnings per share for existing shareholders. There are valid concerns about supply chain disruption affecting various industries, including agriculture. Global events have put a strain on America's agricultural producers and infrastructure, making it difficult for them to access critical resources or export their products. This has been identified as one of the external market factors that may cause stress in related industries. The impact of these disruptions is expected to continue into 2026, with supply chain issues being cited as one of the external market conditions that could adversely affect the farm and food sectors. These concerns highlight the need for careful planning and management to mitigate the effects of such disruptions on the agricultural industry. That concludes the financial summary for Federal Agricultural Mortgage Corporation. Feel free to comment below, and I will be happy to answer them when possible.